Everyone's throwing money at the same AI stocks. Microsoft at a $4 trillion market cap, Nvidia at 36x earnings. But while the crowd chases momentum, I found something very different. 10 tech stocks hiding in plain sight, with explosive fundamentals and deep discounts. One of them just saw $2.3 billion in insider buying. Another, quietly beating Amazon in its niche. These aren't speculative moonshots. They're real businesses priced like broken ones. This isn't about catching falling knives. It's about spotting temporary problems versus permanent damage. Because when markets get emotional, they hand patient investors rare opportunities. I use a simple three-part filter to separate winners from value traps. Strong fundamentals at discount valuations. Temporary headwinds, not structural breaks. Smart money loading up while retail panic sells. Let me show you how this works. Starting with number 10. DigitalOcean, ticker DOCN. This cloud computing specialist serves the fastest growing segment of the market. Small and medium businesses that need simple, powerful infrastructure without the complexity of Amazon or Microsoft. They just reported 14% revenue growth with something even more impressive. Their highest paying customers, the ones spending serious money, grew revenue by 35% year over year. These aren't hobby developers. These are scaling businesses that stick around. The stock trades at just 15 times forward earnings while generating $57 million in positive free cash flow. For context, that's cheaper than most traditional software companies growing half as fast. The problem that spooked investors? Negative shareholder equity of $210 million. Sounds scary until you understand what's actually happening. DigitalOcean used debt to fuel expansion and infrastructure build-out. Recent quarters show this investment strategy paying off with improving cash flow and higher value customer acquisition. This is balance sheet engineering, not business deterioration. Institutional ownership sits at 89%, with Vanguard and BlackRock maintaining significant positions. These firms don't hold failing companies. They understand the difference between temporary financial metrics and operational strength. Number 9. Adobe, ticker ADBE. The creative software giant everyone thinks AI will destroy. They're completely wrong about what's actually happening here. Adobe generates over $8.3 billion in free cash flow annually. That's more cash than most companies generate in total revenue. Their return on equity hits 52%, meaning they're incredibly efficient at turning shareholder money into profits. The market panic centers on competition from tools like Canva and AI-generated content. But Adobe isn't fighting this trend. They're monetizing it through their Firefly AI platform. Here's what the pessimists miss. Adobe's mobile Firefly app combines their AI models with OpenAI and Google's technology. Instead of being disrupted, they're becoming the platform that integrates everything. Recent partnerships with Amazon Web Services, IBM, Microsoft, and Publicis Group aren't defensive moves. They're offensive strategies to embed Adobe's tools into enterprise workflows where switching costs are massive. The stock trades at 22 times forward earnings versus historical averages above 30. Multiple executives increased their stakes during recent months when the stock dropped 15% year-to-date. When leadership buys during market panic, while expanding strategic partnerships, that's your signal. Number 8. Alphabet, ticker GOOGL. Here's a $2.4 trillion company trading at just 20 times earnings. Compare that to Microsoft at 39 times, or Tesla above 60. The market is pricing in worst-case antitrust scenarios. Google faces regulatory pressure over search monopoly claims and App Store policies. But here's what the fear merchants completely miss. Google Cloud grew 28% last quarter to $12.3 billion in revenue. That's not slowing growth. That's acceleration in the highest margin business segment. Their AI overviews now serve 1.5 billion users monthly. YouTube continues dominating video advertising. Android runs on billions of devices worldwide. These aren't businesses that disappear because of regulatory pressure. The Epic Games court ruling in July sent the stock down over 2%. But removing uncertainty is better than living with it. Now we know the actual impact. instead of fearing theoretical worst-case scenarios. Warren Buffett's Berkshire Hathaway holds over $50 billion in Alphabet shares. When the Oracle of Omaha maintains that position through regulatory noise, that tells you everything about intrinsic value versus temporary perception. Number 7. Micron Technology, ticker MU, memory chip, specialists sitting at the center of the AI infrastructure boom. But Samsung just declared a price war that sent Micron tumbling 5% in a single trading session. Here's the contrarian setup that has smart money accumulating. Micron posted 37% revenue growth in their latest quarter. Net income jumped 210% to over $2 billion. Their high-bandwidth memory chips are literally irreplaceable for AI training. Samsung's pricing aggression targets the HBM market where Micron has technological leadership. This isn't demand destruction. It's competitive positioning in a market where supply can't keep up with AI infrastructure build-out. The numbers tell the real story. Q4 guidance calls for $10.7 billion in revenue, up 38% year-over-year, with gross margins expected at 42%. That's not a company under existential threat. Recent institutional buying surged during the sell-off. Major investment portfolio managers understand that cyclical pricing pressure creates accumulation opportunities in structurally growing markets. Micron's partnership with Nvidia for HBM3E production gives them front-row access to the fastest-growing segment of AI infrastructure. When Nvidia needs your chips, you're not getting disrupted. Number 6. Intuitive Surgical, ticker ISRG. The robotic surgery leader that's revolutionizing operating rooms worldwide, but facing temporary headwinds that created this buying opportunity. Revenue grew 21% last quarter, while their Da Vinci system performed 2.6 million procedures globally. That's not slowing adoption. That's mainstream acceptance of robotic-assisted surgery. The recent sell-off centers on two concerns: hospital capital expenditure constraints and increasing competition from companies like Medtronic and Stryker. Here's why both concerns are overblown. Their Da Vinci 5 system just received European certification in July 2025, opening massive international markets where regulatory approval was the only barrier. More importantly, Intuitive Surgical maintains zero debt with $555 million in quarterly free cash flow. Financial strength provides reinvestment flexibility while competitors struggle with funding advanced R&D. Their Ion platform, designed for lung procedures, saw 52% procedure growth last quarter. This isn't a one-product company. It's a platform expanding into new surgical specialties with huge addressable markets. The median analyst price target of $575 implies 19% upside. But the real opportunity is global market expansion as robotic surgery becomes standard care rather than premium option. Number 5. Meta Platforms, ticker Meta. Up 21% this year, but still fundamentally undervalued relative to advertising market dominance and AI infrastructure investments. 3 billion users across Facebook, WhatsApp, and Instagram create an unbreachable competitive moat. Their AI advertising automation generates over 50% profit margins on $170 billion in annual revenue. The persistent concern? Metaverse spending that seems disconnected from revenue generation. But Reality Labs' losses represent innovation investment, not value destruction. Here's what changes the narrative. Meta's AI advertising tools now automatically optimize campaigns across their entire ecosystem. Small businesses get enterprise-level targeting without hiring agencies. That's financial planning made simple for millions of advertisers. Recent financial advisor sentiment shows growing optimism as institutions recognize the disconnect between metaverse headlines and core advertising business strength. Instagram Reels directly competes with TikTok while leveraging superior monetization infrastructure. WhatsApp Business enables commerce in emerging markets where traditional payment systems don't exist. Number 4. Microsoft, ticker MSFT. Yes, Microsoft at $4 trillion market cap makes this contrarian list. Here's why that's not crazy. Azure Cloud Services grew 39% last quarter while they're investing $80 billion in AI infrastructure this year. Revenue jumped from $198 billion before ChatGPT launched to approaching $282 billion now. The contrarian element? Markets expect perfection at these levels. Any slight deceleration creates buying opportunities in a company with decades of consistent execution and compound interest through reinvestment. Their partnership with OpenAI isn't just about ChatGPT. It's about integrating AI across Office 365, Azure, and Windows to create switching costs that make customer churn nearly impossible. Recent restructuring cut 7,000 jobs while increasing AI spending. That's not downsizing. That's reallocating resources toward the highest growth opportunities in technology. Number 3. Supermicrocomputer, ticker SMCI. Here's where contrarian investing gets genuinely interesting. Down significantly after missing Q4 estimates and posting negative free cash flow of $272 million. The AI server market remains explosive, and Supermicro's liquid cooling technology and rack systems stay critical infrastructure for data centers running high-performance computing. But institutional buying activity tells a story the headlines miss. Major funds accumulated shares during the sell-off, recognizing execution issues versus fundamental demand problems. This requires careful position sizing and risk management. High reward potential, but only for investors comfortable with operational volatility in a company that's scaling rapidly. Number 2. Nvidia, ticker NVDA. Nvidia on a value list sounds insane until you understand the math. Despite trading at 36 times forward earnings, they're posting 75% revenue growth to $130 billion with 60% profit margins. Those numbers justify premium valuations when execution continues. The contrarian angle? China export restrictions create temporary headwinds, while global AI demand accelerates everywhere else. Geopolitical pressure represents policy risk, not technology or demand risk. Data center revenue hit $39.1 billion last quarter, representing 89% of total sales. When you dominate the infrastructure enabling the AI revolution, premium pricing gets justified through irreplaceable technology. Institutions keep accumulating despite valuation concerns because Nvidia doesn't just participate in AI growth, they enable it. Before I reveal number 1, let me show you how I structure these positions for maximum upside with managed downside risk. Core holdings in established players like Microsoft and Alphabet. Smaller positions in higher risk plays like DigitalOcean and Supermicro. The key insight is distinguishing temporary problems from structural breaks. Regulatory pressure on Alphabet, temporary policy risk, Samsung price wars against Micron, temporary competitive dynamics, Supermicro's execution issues requires monitoring but likely operational, not strategic. Number 1. The most compelling contrarian opportunity in technology. Intuitive Surgical takes the top spot for a combination of factors that create the perfect wealth-building setup. Pristine balance sheet with zero debt. Expanding international markets through regulatory approvals. Exceptional profitability metrics that combine growth with cash generation efficiency. The recent competition concerns from Medtronic and Stryker created this temporary discount in a company that dominates robotic surgery with technological moats built over decades. Multiple insider purchases signal management confidence in long-term prospects despite near-term competitive noise. When executives buy during uncertainty, they're betting their personal financial independence on the business they know best. This represents quality growth at temporary markdown pricing. Exactly what patient value investors target for retirement savings and long-term asset allocation. The robotics surgery revolution is just beginning. Intuitive Surgical dominates with technological leadership, training infrastructure, and installed base advantages that won't disappear because competitors launch similar products. While everyone chases AI momentum at peak valuations, we're positioning in quality companies facing temporary sentiment challenges. These 10 stocks offer different risk-reward profiles within the contrarian framework. Some require more patience than others, but all provide explosive upside potential when market sentiment eventually aligns with underlying business fundamentals. Subscribe for more opportunities the crowd is missing. And tell me in the comments which stock interests you most for your investment strategy. Because while others chase yesterday's winners at today's peaks, we're buying tomorrow's leaders at today's discounts.